Picture this. It's a Tuesday evening in 1987. Your grandmother sits at the kitchen table under the warm glow of a single lamp, her reading glasses perched on her nose. Spread before her are bank statements, a worn checkbook with a marbled cover, and a calculator the size of a paperback novel. She's not stressed. She's not overwhelmed. She's simply doing what she does every month, accounting for every single dollar that came in and every single dollar that went out. There's something almost sacred about that ritual, the quiet scratch of her pen, the satisfied click when the numbers finally balance, the way she'd tuck those statements into a manila folder labeled with the year, filed away with all the others dating back decades. She knew exactly where her money was, where it had been, and where it was going next. Fast forward to today, we've got banking apps that ping us 17 times a day. We've got overdraft fees that hit our accounts before we even realize we've overspent. We've got subscription services pulling money automatically while we sleep. And somehow, despite all this technology that's supposed to make our lives easier, millions of Americans are living paycheck to paycheck, drowning in fees, and wondering where their money actually goes. Here's the thing. Your grandmother wasn't smarter than you. She didn't have a finance degree or some secret insider knowledge, but she had something that's become rare in our world of instant everything. She had discipline, awareness, and a handful of banking habits that actually worked. And here's what nobody tells you. Those habits still work in 2026. They're not flashy, they won't make you rich overnight, but they will save you real money, the same way they saved her real money, month after month, year after year. These are legal, time-tested money habits passed down through generations. This video is for educational purposes only. What you're about to learn isn't about gaming the system or finding clever tricks. It's about going back to basics, the kind of basics that kept our grandparents out of debt and helped them build something solid, one careful decision at a time. Before we dive into the specific habits, we need to understand why Grandma's approach to banking was so effective. It wasn't because banks were inherently better back then. They weren't. It wasn't because money went further, though that's debatable. It was because she approached banking with a completely different mindset than most of us do today. Your grandmother saw banking as a tool, not a relationship. She didn't trust banks to take care of her money. She took care of her money and used banks as a secure place to store it. That distinction matters more than you might think. She never assumed the bank was looking out for her best interests. She never believed that just because money was in her account, it was safe from her own spending impulses. She understood that financial institutions are businesses designed to profit, and she operated accordingly. Her habits were built on three core principles: discipline, awareness, and patience. Discipline meant doing the hard things consistently, even when they weren't fun. Awareness meant knowing exactly what was happening with every account, every statement, every charge. Patience meant understanding that building security takes time and that every dollar saved today compounds into something larger tomorrow. Banks have changed dramatically since your grandmother's time. We've seen the rise of online banking, the proliferation of fees, the emergence of financial technology that can either help or hurt us. But human nature hasn't changed. We still struggle with the same temptations, the same impulses, the same desire for instant gratification. And that's precisely why these old-school habits remain so powerful. They address the real problem, not the technology, but the behavior behind how we use that technology. What you're about to learn isn't outdated wisdom, it's timeless wisdom, adapted for a modern world that desperately needs it. Knowing every dollar's job. Your grandmother had a system that seems almost quaint by today's standards. She used envelopes, actual paper envelopes labeled with categories: groceries, utilities, savings, entertainment, emergency fund. When she got paid, she'd cash her check and divide the money into those envelopes. Each dollar had a job, and it couldn't be used for anything else. This wasn't about being rigid or joyless. It was about clarity. When the grocery envelope was empty, she stopped buying groceries until the next payday. When the entertainment envelope had money left over, she could spend it guilt-free because everything else was already covered. There was no mystery, no scrambling, no hoping there was enough money in the account when a bill came due. The modern equivalent isn't stuffing cash into envelopes, though you absolutely could do that if it works for you. The modern equivalent is assigning every dollar a purpose the moment it enters your account. Before you spend a single cent, you know exactly how much is allocated for rent, for car insurance, for groceries, for that streaming service you keep meaning to cancel. This requires you to sit down, probably once a month, and make a plan. Look at your income, look at your fixed expenses, look at your variable expenses. Assign amounts to categories. The beauty of this approach is that you never wonder if you can afford something. You already know because you've already decided where that money needs to go. You're not depriving yourself. You're giving yourself clarity, which is far more valuable than another impulse purchase you'll forget about in a week. When you know every dollar's job, you stop treating your checking account like one big pool of money that's either there or not there. You start seeing it as organized, purposeful, and entirely under your control.
Your grandmother hated fees the way some people hate slow internet. She saw them as completely avoidable taxes on carelessness, and she made it her mission to never pay one, not because she was cheap, but because she refused to hand over her hard-earned money for nothing in return. Back then, the fees were different, but the principle remains identical. Overdraft fees, minimum balance fees, ATM fees, monthly maintenance fees, paper statement fees. These charges add up to billions of dollars every year, extracted from people who simply weren't paying attention or didn't understand the rules of their accounts. Grandma avoided fees through awareness and planning. She knew her account minimums and made sure she always stayed above them. She knew when bills would hit her account and made sure the money was there beforehand. She withdrew cash from her own bank's ATM, never from some random machine at a gas station that would charge her $3 for the privilege of accessing her own money. The modern approach requires the same mindset. Read your bank's fee schedule. Actually read it. Understand what triggers fees at your specific institution. Set up low balance alerts on your phone so you know when you're getting close to a threshold. Schedule bills for days when you know your paycheck is cleared. Use your bank's ATM network or get cash back at stores where you're already shopping. If your bank charges monthly maintenance fees and you can't consistently meet the requirements to waive them, that's not the right bank for you. Plenty of institutions offer truly free checking with no strings attached. Your grandmother wouldn't have tolerated paying for the privilege of storing her money, and neither should you. This isn't about gaming the system. It's about being a conscious consumer of financial services and refusing to subsidize the bank's profit margin with your inattention.
Using banks for safety, not lifestyle. Here's something your grandmother understood instinctively. A bank is not your friend. It's not your life coach. It's not a status symbol. It's a secure place to keep money that needs to be liquid and protected. That's it. She never viewed her bank as a measure of success or a reflection of her identity. She didn't care if the branch had marble floors or if the debit card came in rose gold. She cared about safety, accessibility, and reasonable terms. She used the bank as a tool, nothing more, nothing less. This mindset kept her from falling into one of the most common traps in modern banking, lifestyle creep, enabled by credit. Your grandmother was deeply skeptical of credit cards, not because she didn't understand them, but because she understood them perfectly. She knew that easy credit makes it easy to spend money you don't have. She knew that banks offer you credit not as a favor, but because they profit when you carry a balance. She operated on a simple principle. If the money isn't in the account, you can't afford it. Period. No rationalizations about how you'll definitely get paid next week. No mental gymnastics about how this purchase is actually an investment. Just cold, clear reality. Adopting this habit today means resisting the constant pressure to upgrade your banking experience into something fancier than it needs to be. It means saying no to the premium account with features you'll never use. It means viewing credit as a tool for building credit score and earning rewards, but only if you pay the balance in full every single month. Your bank account should be boring. Your budget should be boring. The excitement in your life should come from experiences and relationships, not from wondering if your rent check will clear. Paying attention to timing. Your grandmother was a master of timing, not in some manipulative way, but in the way any organized person understands how systems work and plans accordingly. She knew when her statement closed. She knew when her paycheck would clear. She knew which bills came out on which dates. This awareness gave her incredible control. One of her simplest habits was matching her bill payment schedule to her income schedule. If she got paid on the 1st and 15th of the month, she'd arrange for major bills to come out a few days after those dates, giving the deposit time to fully clear and be available. She never cut it close. She never hoped the timing would work out. She made sure it would work out by planning ahead. She also understood grace periods, those windows of time where you can pay a bill after the due date without incurring a fee or penalty. She never abused this. She never treated grace periods as extensions, but she knew they existed, which meant she never panicked if something came up and a payment needed to be made a day or two later than planned. The modern version of this habit requires you to actually look at your calendar and your bank account together. Map out when money comes in and when money goes out. If there's a mismatch, contact your service providers and ask if you can change your billing date. Most companies will accommodate this request. It costs them nothing, and it can save you from overdrafts or late fees. This is also about understanding business days versus calendar days. Your grandmother knew that deposits made on Friday afternoon might not be available until Monday. She planned accordingly. Today, with instant transfers and mobile deposits, timing has gotten faster, but it hasn't become irrelevant. You still need to understand how long transactions take at your specific bank with your specific account type. Timing is power, and power comes from preparation. Relationship banking. Your grandmother probably banked at the same institution for decades. Not because she was stubborn or resistant to change, but because she understood the value of being a known customer. She walked into that branch, and the tellers knew her name. The manager knew her name. When she had a question or a problem, she wasn't just account number 4728392. She was Mrs. Johnson, who'd been banking there since 1965. This mattered. When fees were charged by mistake, they were reversed with a phone call. When she needed a cashier's check on short notice, it wasn't a problem. When she wanted to understand a new product or service, she got straight answers from people who understood she wasn't going to be upsold on things she didn't need. The modern equivalent isn't necessarily banking at a big branch where turnover is high and nobody recognizes you. It's considering credit unions and community banks where members and customers are valued differently than they are at massive national chains. These institutions often have lower fees, better rates on savings, and actual human beings who answer the phone when you call. Relationship banking also means being a pleasant, reasonable customer. Your grandmother was never rude to bank employees. She understood they were doing their jobs. She asked questions politely. She said thank you. And because of that, people were willing to go a little further to help her when she needed it. This doesn't mean you accept poor service or unfair practices. It means you approach your banking relationships with the same courtesy and consistency you'd want from others. It means staying with an institution that treats you well and leaving one that doesn't. but giving them a chance to make things right first. In a world of faceless apps and automated systems, there's still enormous value in being someone's actual customer rather than a data point in an algorithm.
Simple habits stacked together. Now let's talk about the smaller habits your grandmother stacked together, the ones that individually seem minor but collectively create a fortress of financial awareness. First, she manually reviewed every statement, not just glancing at the balance on an app, but actually reading through each transaction. She caught errors, she caught fraudulent charges, she caught subscriptions she'd forgotten about. She knew exactly what left her account and why. The modern version takes 10 minutes a week. Sit down with your phone or computer and scroll through every transaction from the past 7 days. If you don't recognize something, investigate it immediately. This single habit prevents countless problems before they become expensive. Second, she maintained cash awareness. Even though most of her transactions went through her checking account, she kept some cash on hand and knew exactly how much she had. Cash makes spending real in a way that swiping a card never will. You physically hand over money and watch it leave your possession. There's psychological power in that. You don't need to operate entirely in cash, but keeping some around and knowing how much creates a tangible connection to your money that's easy to lose when everything is digital. Third, she kept her financial life simple. She didn't have 17 accounts spread across 9 institutions. She had checking, savings, and maybe a certificate of deposit. That was it. Simplicity meant clarity. She could track everything without spreadsheets or apps or complicated systems. The more accounts you have, the harder it becomes to maintain oversight. Unless there's a compelling reason, like chasing sign-up bonuses, which your grandmother would have found exhausting. Keeping your banking simple makes everything else easier. Finally, she waited before making decisions. Not everything requires instant action. Someone offers you a new credit card? Wait a week and see if you still think it's a good idea. Your bank wants you to upgrade to a premium account? Wait and actually calculate whether the benefits justify the cost. This habit of building in a pause between impulse and action saves more money than almost anything else. Grandma's secret weapon: patience. We've arrived at the habits that your grandmother would consider her secret weapons, though they're not secrets at all. They're just deeply unfashionable in a culture that worships speed and instant results. Habit number 9 is understanding compound growth. Your grandmother knew that money saved consistently, even in small amounts, grows into something significant over time. She wasn't trying to get rich quick. She was trying to get secure, slowly. She put money into savings accounts that earned actual interest, back when savings accounts did that, and she never touched it unless there was a genuine emergency. She understood that time was her ally, not her enemy. Today, even though savings account interest rates fluctuate, the principle remains. Money that sits untouched grows. Money that gets spent stays gone. The difference between someone who consistently saves, even $50 a month, and someone who doesn't, isn't about intelligence or income. It's about patience and discipline. Your grandmother had both. Habit number 10 is waiting before spending. This is different from waiting before making decisions. This is about feeling the desire to buy something and then sitting with that desire for a day, a week, or a month. Your grandmother would see something she wanted, acknowledge that she wanted it, and then go home without it. If she still wanted it a month later, and she had the money allocated for it, she'd go back and buy it. But 90% of the time, the desire faded. She saved herself from countless purchases that would have brought momentary pleasure and long-term clutter. In our world of one-click purchasing and same-day delivery, this habit feels almost radical. We're trained to collapse the gap between wanting and having, but that gap is where financial health lives. That gap is where you decide whether you're in control of your money or your impulses are in control of you. Your grandmother's secret weapon was simply this: she could wait. She could delay gratification.
She could trust that if something truly mattered, it would still matter later. And that patience, applied consistently across decades, built something solid and lasting. Conclusion and call to action. So here we are, back at that kitchen table where we started. Your grandmother closing her checkbook, filing away her statements, satisfied that everything is in order. She didn't need sophisticated software or expensive financial advisors or complicated strategies. She needed discipline, awareness, and patience. She needed to know where her money was, where it was going, and why. And she needed to treat those habits as non-negotiable parts of her life, as essential as locking the door at night or showing up to work on time. These 10 habits aren't magic. They won't make you wealthy overnight, but they will save you money in 2026 the same way they saved money in 1986, because they address the real issue, human behavior around money. They work because they're based on principles that don't change even when technology does. Knowing every dollar's job gives you clarity. Avoiding fees preserves what you earn. Using banks as tools keeps you grounded. Paying attention to timing prevents problems. Building relationships creates support. Maintaining simple systems reduces overwhelm. Reviewing transactions catches errors. Using cash creates awareness. Waiting before deciding prevents regret. And practicing patience builds security. None of this requires special knowledge or insider access. It requires choice. The choice to be conscious instead of careless. The choice to be intentional instead of impulsive. The choice to adopt habits that might feel old-fashioned but produce results that are timelessly valuable. If you found these habits helpful, take a moment to share this video with someone in your family who might benefit from these reminders. Leave a comment about which habit resonated most with you, or share a money lesson your own grandmother taught you. Subscribe if you want more content that bridges the wisdom of the past with the realities of the present. And remember, these are legal, ethical, time-tested habits passed down through generations. They're not about outsmarting banks or finding clever tricks. They're about respecting your money enough to pay attention to it, care for it, and use it in ways that align with your values and goals. Your grandmother would be proud of you for watching this. Now go make her even prouder by actually doing something with what you've learned, because wisdom without action is just information, and you deserve more than that.